Good morning, everyone. Hope everyone is well. Tom Dixon here from Pittsburgh, PA, my home office, and I do not have a Pittsburgh logo on, but that's actually a Laurel Valley Golf Club that's close to my hometown. But anyway, welcome again, one and all. And today is largely a members-only case study track. I did invite a few guests who are interested in becoming members, and what we have on the agenda, I'm delighted to have back Steve Gibbs, who you can see on the screen along with me. Steve will kick us off in just a few minutes, walking through some life insurance case studies, just taking, frankly, a little more time than what we have when Steve was on a couple weeks ago, almost 10 days ago, with our friend Scott Bishop. Did a great job as part of the Secure Act and life insurance planning after the Secure Act. So I invited Steve to come back. We had a lot of feedback, positive, of course, that a lot of you would like to go deeper. So that's why I invited Steve back. So again, I'm going to have Steve kick it off with case studies in a minute, and then I will follow up and actually go through what you get as far as member benefits, and then also how to make sure you are accessing the website. But I thought I would just share a picture of my dad as a belated Happy Father's Day for all of you out there. And that's a photo of my dad from about 10 days ago. He's been in a nursing home for almost 2 years and still battling, but that's a moment where we actually gave him a photo from his wedding day, believe it or not. So it's all about gratitude, right? So with that, and by the way, you're welcome and Happy Father's Day to everybody out there belated, and always a special thought for all the mothers out there as well. Okay, so let me just do this before I hand it over to Steve. Tomorrow we have another, I have actually the next 2 webinars are on the Paycheck Protection Program. So I know some of you were, I believe, pursued the Paycheck Protection Program, and clearly it's been evolving in terms of the rules and how it all works, right? So I've asked an SBA administrator, actually Steve Bolger, who was on, gosh, I'm losing track of time, 5 or 6 weeks ago, and had a great session with Steve and some other folks, a banking lawyer, Scott Graham, who's going to come back again tomorrow. Steve is actually traveling with the head of the SBA tomorrow, but one of his deputies, John Fleming, will be on. So again, I think it was 2 weeks ago, they announced changes in terms of the percentages and the forgiveness and the timing and et cetera. A million questions out there. So I'd encourage you, if you haven't signed up, and all these webinars are on the home page, financial, except for the bankruptcy. I'm seeing that. I don't have that posted yet. I'm waiting to confirm the time that day. But make sure you should bookmark the home page, financialexpertsnetwork.com, and you'll always find, as soon as I publish the webinars, they will be on that home page under upcoming webinars on the left. There are a few ways to get there, but it's right on the home page. So I just take a moment to make sure, again, if you have any questions about the Paycheck Protection Program, and or you want to invite your clients, and we're going to talk about that after Steve's done and kind of what we're building to support that idea that you could invite your clients to certain webinars, feel free to do that. And as a member, again, here's an important benefit. You can log in early and post your questions in the question panel as soon as I open that up. And you can also email me in advance and say, Tom, make sure you get to my question, and you're going to have priority. So that's, again, a member benefit. And then last but not least, in terms of the paycheck protection issues, on July 1st or 2nd, waiting to confirm the day, I have Mike Amon, who's head of SBA lending for a regional bank, my bank, based out of Pittsburgh here, FNB. Very knowledgeable, again, was on with Steve and Scott earlier. He's going to actually walk through an application, the forgiveness application, and really give you a narrative around that. So we're going deep on the Paycheck Protection Program, no question about it. I just think, and we've had such great interest, that's telling me that you all value that education. And of course, we're building beyond that. So Feel free to, by the way, in the question panel, post your comments and thoughts on that. Say hello in the question panel, please. Let me know where you're calling in from. I know where many of you are based, but always good to see a hello out there. And with that in mind, I'm going to make Steve the presenter, and then let me give a little backdoor introduction. I came upon Steve when I was reading some work on the CARES Act and doing my normal research on issues, and actually saw a very thoughtful article that Steve was part of that was published in Think Advisor. So Steve's kind of an interesting mix of legal, he's a lawyer, and then he's also licensed as an insurance advisor. But he's been doing estate planning for 15 plus years, and I just found his background and most importantly his content that I've read online to be very thoughtful. So with that, Steve, I'm going to unmute you as I just did, and welcome, and thanks so much for joining us. And I'll feel free to fire away, and then we'll open it up for questions. Steve, I'll moderate those after you're done, but it's all yours.
All right. Thank you, Tom. Thanks for having me back. Appreciate it. And it's nice to be with all of you guys this morning. We had a good time in the last session and just touched on a few case study scenarios. And so I think the goal today is to kind of walk you guys a little bit deeper into that, and hope to stay pretty conceptual with you guys. That some of the feedback that we got is people want to hear concepts. And then, of course, for more details, you could connect individually, with us. So, Tom, can you guys see my slides and everything? Is that
you're all set?
Is that
Steve.
Working?
Yes,
okay.
You're all set.
How do I see it, Tom? I'm not seeing it on my screen here, and I'm just wondering. I've got a big webcam up, so.
Maybe if you want to turn off your webcam, Steve, that maybe your PowerPoint slides will go.
All right.
Let's see if that works.
There we go. I can see it. All right, guys. And you'd rather see the slides anyway, I think. So, all right. So I've just got a couple preliminary slides that I'm going to breeze through. I think you guys know this. You're financial advisors. The idea of converting to a life insurance policy is obviously related to, certain types of priorities. And so, with that, I think in every case, you're gonna look at different considerations. Okay. So, the key is, I think, and when I'm talking to people as a planner, I'm emphasizing the fact that life insurance is a contract. It's why, as an estate planner, that I like it. As an attorney, I've come across a lot of advantages that people have been able to obtain through life insurance. And so obviously in every case, you're looking at that. Thus the purpose for, kind of thinking about the kind of different scenarios that you can utilize life insurance. So that's what our case studies are going to focus on. A couple of different brief scenarios. There are lots of different things that you can do with life insurance, obviously. So as a planner, I think it just helps, sort of round out the picture for you guys. And that's my hope at this point. So with that, you've got some considerations. Taxes, income, risks, life insurance are contract. Life insurance products are all contracts. We know that, but that's just something I want to make mention of. And that includes annuities and these things. So basically, whenever you do a life insurance product, you're sort of trying to reallocate the risk of whatever their financial scenario is by purchasing this contract. All right. So you've also got, and you could have different scenarios. So you could be, just adding, you can purchase a life insurance contract to diversify for them, right? So they could take existing assets, convert them, cash, whatever it is. And sometimes we also talk about converting a qualified account of some kind. And in our last session, we touched on that as far as using say an IRA, 401k, converting that. And of course, there are issues around that, and that needs to be well thought out when that's done. One of the things that's happened for those of you maybe that weren't part of the last session is just the Secure Act and these kinds of things. And so it's changed the picture and made it more advantageous to potentially use life insurance rather than stick with that account, particularly the qualified account as a beneficiary due to some of those things. So those are just issues that I want to make you guys aware of. There's also the CARES Act, so you can remove funds if you qualify from a qualified account, and what to do with that becomes a question. So that's another aspect of using life insurance and the potential to use life insurance. So I just want to point out a couple more things. You're always dealing with the question of deferring versus paying taxes. So, this is kind of just a before tax and after tax picture of a qualified account. So a lot of times when you're using life insurance, you're trying to look at what's going on with the policy, and you know that it's going to be basically a tax-free benefit or tax advantaged. So we're going to touch on that as we dive into the case studies. All right. So the first one that I wanted to share with you guys is just using a whole life insurance policy as what we call a LIRP. All right. And LIRP stands for Life Insurance Retirement Plan. All right. So it's a way to take assets, and obviously you're not bound by the parameters that cover, say, an IRA, 401k in terms of maximum contribution. So you can kind of put as much as you think is wise into a life insurance policy, and utilize that not only for life insurance but also use it for later retirement planning. So that's what we're going to dive in first, and we're using a whole life policy because there's a lot of debate around it, whole life versus what we call an indexed universal life. I'm sure you guys are familiar with these terms for the most part. Whole life has predictability to it. You're not being as speculative, even though there's a lot of contractual security in an indexed universal life policy. The big difference is that you're given guarantees on a whole life policy, and so you can predict what's going to happen to a large extent. You'll notice that there's guaranteed assumptions and there's non-guaranteed. The main difference with a guaranteed and non-guaranteed the portion of this policy and how they're illustrated is just dividends. Okay, so a lot of these companies, they've been paying dividends for 100 plus years. They haven't had a glitch. So you can talk to people and say, there's a solid foundation to expect dividends. If they're not there, we might have bigger problems than just the whole life, maybe missing out on the market or whatever maybe the criticism would be. There's always back and forth. I appreciated on our last call, there was some support for whole life in the discussion. So, and there's a lot of reasons to really like whole life insurance. What happens in a whole life policy is that the life insurance company bears the risk. And so from the standpoint of diversifying assets, you've got a predictable asset with guaranteed growth over time. And we do a lot of calculations. So and I'm going to show you guys an IUL in a second. But, we run calculations, and a lot of times when you're illustrating an indexed universal life policy, you're going to assume a rate of return, maybe 6%, something like that. And there's indexing attached to that. Whereas with whole life, you're really looking at what we see here. You're looking at your guaranteed and non-guaranteed assumptions. All right. So let's say in our example, we're putting in 5 years, we've got premiums coming in. So what we're doing in this case study is we're putting $24,000 a year into the policy. That's basically $2,000 a month that someone's elected to put into their policy at age 40. Okay, so these are your ages over here, and you're at age 65 here on the bottom left. All right, and so in this case, and this is an actual illustration run on a healthy 40-year-old male. And so you can see it's going to take some time. And one of the sort of criticisms or questions about whole life is it takes a while, and the idea that it's expensive and these kind of things. But what you have is a few huge aspects of this. You can see it kind of catch up, right? So you can see, I just want to show you your cumulative premiums in year 10 and your really expected cash value with the historic dividends. So you've surpassed your premiums, and you've got a pretty sizable death benefit over here. And The thing about these policies is that, you can, the longer you hold them, the more that your yearly dividends and cash accrual is going to substantially outpace your premiums. And you can kind of decide too how long. This is just one example. This is not, there are so many ways to design a policy. So you can decide how long you're going to pay premiums. This one runs them out, so they're going to keep paying premiums unless you have continued, you have a little more growth. So you could do a 10 pay where you're paying for 10 years, or 20 pay, and that obviously changes the picture. So this one is just running out, and we're showing at age 66, we're not taking any income out of this. So I just wanted to show you how the cash value can work. And this is at $2,000 a month, keep in mind. So very powerful. And what we're going to show you concerning the income, if you want to design this as a life insurance retirement plan, you can take income out, and that income is often taken out in the way of loans. So policy loans are not taxable. So basically you have tax-free income in retirement, and what that will do is it will change the picture a little bit. But this is just without that, and I'm just wanted to show you this first, just in terms of account growth. Okay, so usually, and then people may say, especially financial experts like yourselves may say, well, what kind of return? And a lot of times you can do a calculation on it, and you're getting 4 or 5% every year. So that's the important piece of the puzzle. Whereas with other products, if you have down years in your experience, which is historically will be the case, you might have a flat year of 0, where you're not going to, this kind of an asset, you're not. And so that's another piece of the puzzle in terms of diversifying and having some predictability. And I talk a lot with folks about predictability. You need predictability in your documents, and you need predictability in some of your assets so that you could pursue perhaps other higher risk assets. And that's the idea. So, all right. So let's see, go to the next slide here. All right. So I just wanted to show you this is kind of the way we run calculations a lot of times. So, obviously we're not doing a side by side with an IRA necessarily, because you're limited on your contributions. However, this is what, when you have a tax advantaged account, we just ran the calculations out just to show you, basically, the difference in what you could expect, in terms of, we're taking management fees out of here, of course, and you always, the other thing is a lot of times when you're comparing to other kinds of accounts, you may not be thinking about your management fees. There's always a lot of discussion around fees when you're talking about life insurance, but not so much in other kinds of accounts. So we include them, and we've got a 24% tax bracket, which is probably conservative. And so you can see how the alternate account, same deposits into the account, and we're using our 24,000, so 2,000 a month. You're seeing in the early years, you can see how it surpasses, and then the life insurance side kind of catches up, and then you can see it down in the later years, the difference. And so I just wanted you guys to see that. The interest rate on alternate account to match, which PLI is permanent life insurance, in this example is 8.57%. And that would be, you got to kind of think about that as every year. So big difference from sort of averages and these kind of things. All right. So this is our same example that we just did. This is 41 policy values. Only this time we're going to start taking income out. Okay, so we're going to take income out we decided to take income out at age 66. Okay, so we're going to take it out in this case, in this example, and again, you can arrange these examples however you want, but we're going to take income out until age, looks like we did 87, 88. And so you can see that depletes the cash value down. And so what you might do is, you're looking at life expectancy. So you might, based on your premiums and expected growth, then you could design a policy that would draw down, the the cash value. And you can also see the death benefit goes down. And a lot of people get confused about, I think you're losing your cash value, and really your cash value funds your death benefit. And so there's no smoke and mirrors about that. It's kind of like the equity in the house versus the house itself. If you were to pass that to the heirs, if it were heavily leveraged, then you wouldn't have the same amount of equity there. And that's the same thing when you're drawing down a policy. However, this is think about the fact that this is tax-free, basically tax-free income. So it's a huge, I mean, when you think of adding 24% or whatever the tax bracket is in another kind of account, you've got a lot of income that's being pulled out of this policy. And the other thing it's worth mentioning in these policies is that you do have a lot of long-term care, chronic care, and these kinds of riders that are attached as well. So you have some additional advantages for taking funds out in those kind of circumstances. So this is our whole life LIRP. There's probably other questions around whole life. And again, this is just conceptual, one way of thinking about it, using whole life insurance for retirement planning. So that's that case study. Of course, some of you guys who might be familiar with Index Universal Life and thinking that person may want to take something and have an opportunity to have experience market gains in potential high years. So what I did is I just threw in an illustration. Now this is only $13,000 a month in premium, or $13,000 a year, sorry, in premium. And so it's a different picture. However, when you illustrate an IUL, basically what you're doing is you're going to estimate a return on that if you're going to illustrate it, and it's maybe based on a moving average of the market over various periods. And so the thing with an Index Universal Life policy, and this one is taking $32,000 out in income at age 65. So you can see the one thing about an Index Universal Life is you're making more, you are speculating a bit more than, I like to be pretty candid with people and say, well, the thing with Index Universal Life is it does switch the risk back to the consumer, because the consumer is risking a zero return in those years. And a lot of people that sell IULs talk about the power of indexing. And if you have a 0 year, you're going to have a floor. You can't lose. Other proponents of whole life might say you can lose because you're going to have costs in those years as well, which is true. So you're making more assumptions with an index policy. So, you can see these rates of return continue to improve and as time goes on in the same way. And if you ran a side-by-side with the illustration IUL and whole life, you most likely see the IUL projected to exceed the whole life policy in terms of the cash value. However, there's also assumptions there. And sometimes, depending on the company and the illustration, you can see that the estimated return on that IUL isn't exactly what it's being portrayed. So that leads to the question of, where did the extra return go? And a lot of times you can kind of see that it ended up in cost. So my point on that is some people really want to use the IUL, and you can, but you just need to make sure it's designed well and that you understand how it's being illustrated. That's huge. In the world of life insurance, how an IUL is being illustrated is pretty much everything. So whereas with whole life, it's really more a matter of design. And the other thing I was going to mention with both of these guys is these are not life insurance policies that we're just paying for death benefit. We're actually using a max cash value scenario. So we're actually doing paid up additions on the whole life policy, and we're also using a form of that with the IUL. Okay, so you're trying to put extra cash into these policies. So, and sometimes you'll supplement the death benefit with term life insurance, at least for a time, and a lot of times that will drop off. Okay, so what you're trying to do is get the death benefit up there so that you can put enough cash to make the whole picture make sense. Because otherwise, due to what we call the modified endowment contract limits, you're not able to put as much cash into the policy as you'd like. So you're usually trying, it takes somebody with some experience in max cash policies in order to design these things to do this kind of thing. All right, so that's something to be aware of, that your average insurance agent may not be aware of really how to design these policies for cash accumulation and to do a LIRP, which is really what this case study is all about. Okay, so let's see. All right, let's see if there's anything else I need to show you guys. You can see the, you can see the rates of return that again are projected over here on the IULs. Okay. All right. So let's see. Sorry, guys. Let's see. All right. So in our next example, so that's the LERP. And again, IUL whole life. That's really what you're doing for retirement planning. I also wanted to really quickly propose a second to die GUL. A GUL is another kind of universal policy, but it's a guaranteed universal life, and it's really for death benefit. Okay, we're not trying to accrue cash in this kind of a policy. All right, so in this case, this would be somebody that wanted to put maybe a lump sum of some kind into what we call a GUL for a death benefit. So because of all the changes under the Secure Act, and with you have to pay out an inherited IRA would need to pay out within 10 years. You guys are probably aware of that at this point. So a lot of times people now, either somebody older that was going to pass assets to a future beneficiary, or possibly someone that inherited an IRA might do a lump sum and do a GUL. Okay, just to pass assets to their heirs, because it's not really an income play. So, but the thing is, sometimes we'll use a SPIA, which is a single premium immediate annuity. We touched on this in the last session. And the only reason you do that is if you didn't need the income and you wanted to earmark that money for life insurance premiums and perhaps squeeze a little more money out of the what's there and put some guarantees on it. Okay, so if you say you had a $200,000 IRA, you could cash it out and, take the tax hit and then purchase, the policy, but you still can't put it all into a policy. It's going to have to be over time, say 5 to 7 years. Okay, so the reason that this is here then is to help bridge the gap. You could roll that money into a SPIA, into a qualified account, actually qualified SPIA, and then fund a life insurance policy under this kind of scenario. And this would be a second to die. All right. So in this example, you wouldn't have to use a second to die. However, a second to die is going to be a little more bang for the buck on the death benefit. And if the spouse doesn't need it, the second to die only kicks into gear upon the passing of the last spouse. Okay. So in this SPIA, we're putting $200,000 into the SPIA. It's kicking out an annual payment. Okay, and this is just how SPIAs work. They give you, sometimes you can put a formula to how much, but this is more of a fixed income kind of a scenario. And so this is what this SPIA was doing, and this is our I believe we did a 65-year-old on this one, and it doesn't really change based on age. SPIAs are different than life insurance. So, all right. So then what we did is we took the annual amount of premium and we poured it into a second to die guaranteed universal life policy. You can see the cash value here is minimal. This isn't going to accrue a lot of cash value, but what it is going to do is create a fair amount of death benefit. And you want to look over on the right-hand column, the tax equivalent return on investment is what you're really looking at when you're trying to see if one of these policies is going to make sense. And the example I have is we had a 65-year-old come in and he was he didn't need income. He was looking at how to pass assets to heirs in the most effective way possible. And in that scenario, we were able to show him that even after 20 years, he would have far in excess of, and think in that case, it was around a 4% return. And the question to him was, would you invest in something right now that was a safe asset that you could get 4%? He said, absolutely, I would invest in that. And that sort of sold him on this idea of doing the GUL. And again, death benefit, this is something sometimes people get confused. They say they don't like the crediting rates or whatever it is for the cash on a GUL, but we're not really worried about that. We're really worried over, really over here with the death benefit and these kinds of things. So it's a great way. And the thing to keep in mind is that there's no tax consequences. There's no issues for heirs getting a death benefit payment in the same way that if they had to inherit a qualified account nowadays. So it's just another example, a way to earmark it and then fund the GUL. So I just threw this little diagram in here, and these are just the kind of things you can do. This is what we did in the case of the SPIA. I just had this in the case of if we didn't do a qualified account. You could pay the penalty and then fund the policy, but with a SPIA, you can roll it into a qualified account as well. So you're only paying the taxes and, on the distribute, basically, you're rolling it, and then when you get paid, then you've got some taxes there and these kinds of things. So you can use trusts for this kind of thing. You guys have probably heard about using trusts, different strategies around that. And that would be an entirely different webinar. But when you use an irrevocable trust, you're basically helping them to downsize their estate. Let's say they have state tax concerns and these kind of things. So what you're trying to do is move it from their estate bucket out into another bucket, the irrevocable life insurance trust, which can then buy life insurance and pass funds to heirs. So you could do this kind of a scenario with a second to die in an irrevocable life insurance trust, which is done, and you've got this large death benefit that's going to be paid out to beneficiaries from the trust in the future. So Tom, I don't know, how am I doing on time? Am I ready to pass the baton? I can elaborate on anything that needs to be elaborated on.
Yeah. Perfect, Steve. No, we certainly have questions coming in, and folks feel free to post questions. And I apologize, I did not set the stage here again as I should have, as I normally do in the beginning. But Steve was on about 10 days ago as part of a presentation on the Secure Act, all around, all the changes that have come about and the end of the stretch IRA. And as I think many of folks like Ed Slott and Scott Bishop and others have recommended that you really need to think about life insurance planning. And so that's where this really originated, the idea of, coming on and having Steve come on rather and share his expertise. And again, I like the fact that Steve has an estate planning background, and that's why I reached out to Steve. So I think I sort of alluded to the fact that I found some work that he's published as well as part of that. But and admittedly, I was a little ambitious, as I certainly have that weakness of I try to squeeze too much on a session, as I did with that particular session. And we had not only Steve, we had Scott, and then we had Tyler Clark from Money Guide Pro, all of whom did a great job, but frankly probably did not have enough time respectively. So that's what led to today. And again, and just for the record, and I think most of you know this, especially those that have been on many of my webinars, my mission is to really investigate what I think are reasonable solutions, be they whatever the product may be, again, within reason. If I think it's something that will benefit you to learn more about, that's what I'm after. So I wanted to give a little context. And then last but not least, in terms of logistics that I skipped over, a copy of the materials that Steve just went through were emailed to all of you at 10:20 Eastern. And then if you did not see that, a copy is available in the handout section or tab of that GoToWebinar interface that should be on your screen. So again, sorry I failed to cover that in the beginning, but hopefully you can find that if you haven't already. And by the way, for those of you that are members and even the few guests that we have that are interested in becoming members, I always email you in advance of every webinar. So whether it's a case study session like this, or it's one that goes beyond case studies, that's a little broader, I always email you. My goal is to email you the day before with a link to a web page that I've design that just houses the materials for the next webinar. I believe the URL is financialexpertsnetwork.com/member materials for those of you that are members. So anyway, just when you're thinking about, geez, where are those materials? I'd like to, because my goal is so that you can print them out in advance and make notes on the slides as you go. So with that, Steve, let me fire away a few questions and we'll just go through these rapid fire. First from Ted. Ted, good to see you on. Ted is asking, Steve, what are the top 3 life insurance companies for whole life?
Very good question. I can tell you that, I mean, there are a lot of good companies in this realm. The one that tends to, at least for us, I mean, we could argue with other agents and people all day about who's the best, believe me. But Penn Mutual seems to stand out. They seem to be a very, their dividend rates are good, and some people argue over dividends. So believe me, there's all kinds of debates in the arena, but they tend to stand out for us. If you want a really good blue chip company that's a little more conservative but very long standing, Mass Mutual will be good. There's lots, Northwestern Mutual and Guardian claim to be the best, of course. But these are mutual companies. By mutual companies, I didn't get into that, but mutual means that they're technically owned by the policyholders, and that when you get dividends, it's actually a return of premium. So there's some real strong advantages there, and this is why you have the tax favored treatment on dividends as well. And I didn't get into that as much, but so I would say those are standouts. On our website, we do have. You guys are welcome to go to InsuranceandEstates.com. That's estates plural, and you can actually search. We've got top mutual whole life companies, and you could actually look through our whole list of companies and sort of our reasons for sort of highlighting certain companies.
Okay, great. Thanks, Steve. Yeah, good question, Ted.
Yep.
Next from Gary. Gary, good to see you on. When the insured dies, where does the cash value go?
Yeah, that's a good question, and that's one that is a common, I guess you could call it a criticism of whole life. People say, well, you lose your cash value. Well, like I said, I touched on that. The cash value is funding the death benefit. So in other words, you don't get to double dip. So you can't have your cash value and then take the death benefit as well. So it's kind of like, the way I explain it is like the equity in the house and then the house. So you can use that equity to up to the full amount during your lifetime. But what would happen if you leveraged 100% of your home value, right? And then you went ahead and passed it to your heirs? Yeah, there wouldn't be, obviously they're not going to have a lot of equity at that point. And a life insurance contract operates the same way, with the exception that you get guaranteed returns on a life insurance contract where you don't with a piece of real estate. And it's also much more liquid. So when you're taking those policy loans out, you don't have any really much of an application process, turnaround time, and all those things. So that's how I'm obviously a believer in whole life and use it myself. So that's the logic around it. You don't get both, and I think that's a huge misconception that so in other words, you get the death benefit. That is the cash value in a way, because if you don't use the cash value, you're going to have a huge death benefit at that point. So hopefully that makes sense.
Yep, absolutely. And again, Gary, if not, feel free to post back. Next from Michael. Michael has a few different questions. Michael's asking, with interest rates at historically low points, would you think that dividends could be depended on? What would you think that the dividends could be depended on in the future? I see that. Can you depend on dividends in the future? Sorry, Michael, I didn't quite. Yep, your thoughts, Steve?
It's a terrific question. It's one that you can look at it one of two ways. The dividends have still been solid through quite a long period of low interest rates. So you could look at the history, over the last 10 years even, and just see how they've been performing. They've still been in that, a lot of times in that, 4%, especially if the right companies. So some are stronger than others. Some have lowered their dividends more. So that's a really good question. But the flip side of that is that when you're illustrating these policies, it's a fantastic time because we're not dealing with pie in the sky illustrations when it comes to whole life. We're actually dealing with extremely conservative, and maybe interest rates will always be low from here on out. I mean, who knows? But back when, when whole life was, in high gear with regard to some of the infinite banking and things out there, you had these huge, you had super high interest rates, and then you had illustrations that were really wild. And so it's a very good thing, actually, from the standpoint of illustrating. And it hasn't seemed to been, and there are concerns that they can be lower, but then you just illustrate them. It doesn't seem like they're going to match interest rates. You're still going to get a better return than what you're going to get, at least what we're experiencing now anywhere else in terms of a really safe, return on investment.
Okay. Steve, I noticed that we probably have at least 7, 8 more questions, so we have a lot to move through if we could. And that's great. Right. And yeah, folks, I certainly am grateful. I'm sure Steve is to have the question. So Louise had asked initially, and then I think she saw it, that she did not see the interest rate assumptions, I think, for the first case study, and then she saw it somewhere in the slide. Steve, if you want to kind of perhaps advance back or see if you can find that. And also, she did not see the IUL slides in the handout, and I don't know if I thought you had that.
They're not. Okay. No, I was going to mention that, Tom. I may have to just send it to you because I added those after the fact, and I actually added them yesterday because I wanted a chance to elaborate on the IULs. As far as the interest rates, so you're going to see you kind of see your rate of return. And again, all your interest rates on an IUL are estimated. You're basically you might estimate there's formulas that every company uses to kind of estimate what they could expect to see. And so there are more assumptions with an IUL. So you can see your rate of return over on the right-hand side there. And that's just, you can see how it improves over time. As far as whole life, there isn't, you're not going to see an interest rate on here because they don't look at it that way. They actually, but you can see, this is your supplemental portion of your illustration. So you can see with what they're doing there is they're just estimating based on dividends, what their expected dividends would be based on history over that time. So I think for Louise, I think it'd be a matter of just digging into, running some calculations. So you do a illustration, and then you could do a calculator. We use Truth Concepts. There's a lot of them around, and see what we think the actual rate of return is going to be on that. Okay, great. Yep.
Sorry, didn't mean. So one thing, I'm just for everybody listening, it dawns on me, I've had Barry Flagg on a couple months ago. He did a beautiful job talking about life insurance standards and planning under the new CFP standards. And he really just comes at it from a fiduciary perspective, which of course I respect. And I'd like to have Barry on and perhaps tag team with Steve. And Steve, if you're interested, we'll talk about this offline. But Barry has a product called Verality that really compares different life insurance illustrations and really kind of normalizes them. My words, not Barry's, but I think that'd be fascinating. So folks, if you're listening, post a note and let me know if that would be of interest. I've talked to Barry a couple times about having him back and with this idea among others. So again, let me know if that's of interest, if you could, please. Michael's asking, why are these examples or strategies not funded over 5 to 7 years? And then I think he's asking, what was the joint life expectancy as well? So Steve?
Well, that's a good question. You can fund them 5 to 7 years. You can do whatever, you're just not going to be putting as much premium into the policy. So therefore, after the 7 years, then the growth is going to be, whatever is based on the, dividends in terms of whole life. or whatever the market's doing after that. So in our example, we're just saying $2,000 a month just to see how that money can work or over time. So you can illustrate it different ways. And the life expectancy on the second to die would be based on that, whatever it is for male and female. And honestly, off the top of my head, I don't know what the life expectancy right now is for your average male or female. I'm going to guess. I think it's probably 74 for a male, but that's something that certainly could be just discussed when you're doing the illustration. Because again, we're talking concepts, and so the other thing I wanted to mention too with Louise's question was that there are a lot of assumptions in any illustration that you have. So it's a good idea to use the calculations, I think Veralytics or truth concepts or whatever you want to do. You really should dig into it, because otherwise you're not really going to know what you're dealing with. So.
Okay, great. And so next from Patrice. Patrice, good to see you on, and thanks for recently becoming a member, by the way. What type of Patrice is asking, what type of estate would be needed for an ILET? How would the proceeds of the GUL be included upon the second death as value transfers probate free to beneficiaries?
Yeah, that's a very good question. So the way that I would say that it would be done, and I've seen it done, is just IUL buys the life insurance. So the funds can be gifted over. If you might design it so that you could gift $15,000 per year per beneficiary into the ILET. Okay, and then the ILET goes and buys the second to die, pays the premiums. So those policies are payable to the trust. And the beneficiaries, of course, are the takers under the trust. So it would come through the trust. So what you did then is you gifted $15,000 a year per beneficiary into that trust out of the estate at that point, and then that life insurance policy is funded from the trust itself and pays out to the beneficiaries from the trust. So it's clean that way. You don't have any issues with obviously the estate taxes. That's been sort of circumvented, I guess, or avoided. And I hope that was the nature of the question, and if not, it's certainly explored in more detail.
Okay, right, sure. Next from John. John, good to see you on. And John, thanks again for recently signing up. John has done some IULs, but his concern now is, given the low rate environment, Steve, how that's going to play out in these IUL and whole life policies moving forwards. Your thoughts?
Yeah, great question again. I think it's going to be a little... I don't want to be critical of IULs, but I think it's more precarious. When you have low rate environment and also a lot of volatility in the markets, then I think you have a higher potential for the cost scenario to be a problem with IULs. The costs are more, there's more lack of clarity. In a whole life policy, the costs are fixed. And the only thing that's really speculative in a whole life policy for the policyholder are the dividends. So you still got, the guaranteed returns. So you've got this whole, right now, I guess we're looking at non-guaranteed assumptions. But if you look at this original slide, you see the guarantees over on the right, or on the left side rather, guaranteed assumptions. So that's really your, when you're dealing with whole life, if all else fails, you have guaranteed cash value accrual in that policy. So that's not as subject to rates and market issues and things, in the same way that an IUL is, in my opinion.
Okay. And I know Michael has more questions, and I'll just ask this openly. I know for some of you that are interested perhaps in talking more with Steve one-on-one, Steve, are you open to that? I don't want to I'm putting you on the spot, but
no, of course I am. And honestly, my philosophy at Insurance and Estates is, if you're the smartest person in the room, you're in the wrong room. You guys have heard that one. So we've got other people I work with that are probably smarter than me at designing these things. So if you guys want to see illustrations and things and run through scenarios, I would probably invite one of my team members along with us and have that discussion. But I'm certainly, open to doing that, and helping you guys with, understanding this stuff.
Great. And I'll share his email in a second, but Michael's asked a couple times if you could share what the costs are for the whole life policy, Steve.
Well, that's a fair question. They're included in the illustration. So the cost of insurance. When we go through this, the costs are you'd have to, again, I think, Tom, your point about the Veralytics.
Right.
I think you'd have to run a calculation and see what the actual return on investment is in the cash value, and then you would know at that point what the costs are. So,
yeah.
And again, you can do the same thing with an IUL. It's just that it varies more from company to company how they deal with their costs. So.
Yeah, exactly. Okay, so again, we will have Steve and Barry back. Date to be announced. Will be done as a case study again. And I'm sorry because I know we're just I had budgeted 30 minutes for this and we're at 50 minutes. So as always, it's just so much to get into, and this is only 2 case studies really. So again, we will do this again, folks, and I will just leave an hour for it, and certainly willing to, as provided Steve has the time, we'll go deep. And so, Steve, if you're okay, I'll just announce your email, or you can announce it, and
Sure.
let folks contact you to set up time individually.
Absolutely. You guys can email info@, and it's insurance and estates spelled out. So it's info@insurance and then estates plural spelled out. And if you guys send emails there, then we can get something scheduled. And like I said, I'll probably invite one of my team members, and we can do whatever kinds of math and things that you guys are interested in looking into.
Okay, great. Okay. All right, Steve. Well, thank you so much for joining. I'm going to let you continue on with your Monday, and really appreciate you doing this. Right. And look forward to having you back again with Barry. And then right. For everybody listening as well, Steve, when you get me the new slides, when we post the webinar replay, I will revise the slides that are out there now, add anything that you send to me, Steve, so that everybody, again, listening, or those that didn't make it live, will have, whatever you add to it as well.
Sounds great. I'll get that to you, Tom, Good. And I appreciate it. Thanks, guys. Yep.
Great. Thanks, Steve. Take care.
All right.
Okay.
You too.
So, folks, if you're still, thank you very much. If you have time, I'm going to walk through the other part here, and I know it's always a little ambitious with our calendar and what we try to cover, and so that's one of many things I have on my personal improvement list. So I think I've talked about upcoming webinars, and you know what, I'm going to take off the webcam because it is distracting to me. And feel free, again, if you have questions on any of this or any comments, post Steve's presentation or review. I find I really like Steve's easygoing manner. He's just sharing ideas. That's really the whole goal with this. So certainly welcome feedback on that. I don't know that we have a survey set up for today, but please feel free to post your comments in the question panel on Steve and the content, and whether this is helpful or not. I always welcome the feedback. So let me, bear with me real quick. Give me 1 second. Okay, I think you should see. So I've already gone through. Hopefully you see the upcoming webinars. And again, please make sure you're checking the webpage for that. So one of the things I wanted to make sure we covered today is off of the homepage. And again, in the handout section, I've actually made some revisions as Steve was talking to what I had sent out earlier. So sorry, we've got multiple versions. We've got version control issues going on. But there are some slides, and if you just want the ones that I added separately, just let me know. You can email me or just drop a note in the question panel, so you don't have to print them out twice, and you'll see what I mean in a second. But okay, number one, to make sure as a member, for all of you that are listening as members, and it's majority of everyone on the call here, you want to, if you haven't logged in to your account on the website, you can, right off of the home page, if you see where the red arrows are pointing to the login button, and we are going to change the interface here, hopefully in the weeks ahead. You can click that log in, and it will take you to this page. So I've just transitioned on to the next slide, and the URL for that you can see is the financialexpertsnetwork.com/user/login. And from here, you would enter your username and password. Now, for those of you already doing this, easy peasy. That's great. For those of you that have yet to do it, I'd encourage you to start accessing the website, and you'll see why in the slides that follow. You'll be able to really monitor all of your webinar activity and your CE credits with us off the website, and that's really why we've invested in the website, is to help you do just that. So again, and if you don't know, when you get to the page and you don't know your password, if you've joined, I believe it's since early March, we changed the calculation that when you sign up for a webinar, we actually created, unbeknownst to you probably, we created an account for you on our website using your email, the email you use to register for the webinar, as your username. Mine's Tom. I'm one of the few that has that kind of name because I'm an administrator. And then the password, the logic that we used, again, from March on, is your first name, last name, lowercase, no spaces between that, and that should work. That should get you in. As always, you can always click on that tab where I have the red star and reset your password. Of course, you can always email me or even just text me, and I can quickly reset your password. By the way, for those of you that are new members, you're welcome to text me now. Just text me if I don't have you as a contact, if you could just text me. And I prefer text because I get too many robo-phone calls and I don't really pick up my calls, unfortunately, because of that. But if you want to text me your name and I'll know your phone number, and you just tell me it is who's texting. I'll add you as a contact. So again, if you need any sort of emergency help, I'll do the best I can to make myself available. So the key is, once you log in, you're going to be presented with this dashboard, and we are making some changes to it. You'll see, and what it does is it will show you all of the webinars that you've registered for, like the webinar registrations, where it has that number 1. Those are upcoming webinars, and then going left to right, the webinars you've attended. These are past webinars, if you will, ones that you've attended. And then the webinars missed, as it implies, it will show you all the ones that you missed. And then we also have the CE credits icon, which just gives you sort of an intuitive, easy place to click on to actually find all the webinars you've attended for which you've earned a CE credit. We also do report that in the webinars attended bucket. So it's a little bit of redundancy, but I'd rather have that because I just wanted to make it that obvious. Now, for the webinars that you've missed, or again that you've attended, what we will do is hopefully you can see this on the screen. You will see the title of the webinar, the presenters, and then you will see the date, and then you have that view replay button. That view replay button is actually hyperlinked. It's linked to the actual replay page itself. So my goal is to put all this in one easy place under this dashboard that you can quickly access any and all webinars, again, whether you've missed them or you've attended. Now, For the replay page, right, here's, I just thought it was important to review this to make sure you really understand, one, how to get there. So again, you're coming in through that dashboard. You need to log into your account. Hopefully that's easy peasy for you. And if not, just let me know. But once you get into that dashboard to access the replays, you can either, if you attended, you could still go back and listen to the replay, and many members do, or you can, if you missed it, of course, find it that way. Now, here's a screenshot of the webinar that was on April 24th with a few different panelists. And the reason I show you this is this is the only webinar that actually has, if you see the images on the right, 2 versions of the webinar replay. The bottom one is actually a short form. It's about a 15-minute version, which is just around the CARES Act and the retirement accounts, what's possible with retirement accounts, RMDs, etc. The waiver for the pre-59.5 penalty this year, all of that. I edited the video so that you could just look at that. Plus, again, that arrow pointing to the helpful resources and documents. I actually created a transcript. I edited the transcript and created a short version of that. So again, that's an example of, this is a little special, session for you, if you will. Again, and then the top video, by the way, is the entirety of the webinar. So this is all available to you under either webinars attended or webinars missed. Now, feel free to, by the way, I hope if you have questions out there, feel free to post questions on any of this. I certainly would welcome your comments to see, if you've actually tried to log in or not, and if you've had any problems. If you have tried, that would be helpful to me. Okay. All right. Next. This is, again, a visual. I've been chatting about this, and I've shown this a little bit even live online as well. And I'm going to send out a survey to ask for your, to try to measure your interest in this. But we've been building this capability in the background, if you will, and it's actually live. And if you're interested in being part of the test group, please drop me a note. And I think everybody generally knows my email, but it's my Tom@financialexpertsnetwork.com. But what we've built is the ability for you to invite your clients and or your referral partners, folks like CPAs, lawyers, realtors, whoever, right, to certain webinars that we host and organize. To do that, your first step would be to load their contact information, basically their name and email, and it's a very straightforward process. And again, if you're listening and you're interested, let me know, and I'd be happy to do a quick one-on-one call with you to show you how this works. You'll load them in, and then once you do that, you'll actually see them on your dashboard. Whoops, went a little too quickly there. And again, this is a screenshot. I could show you this live. And so think about this. Not only, again, could you, and I'm trying to make changes and keep enhancing this to get it to where I want it to be, and then I certainly want your feedback on how we design all this. But this is an example of, imagine having your referral partners in there as CPAs, for example, and being able to see which webinars were of interest to them, how many they attended, and then I actually should tweak where it says CE credits awarded in the middle of that screen down here. Imagine being able to offer them CPE, continuing professional ed credits, as your guest on the Financial Experts website. So I'm investigating that right now. We've investigated. Let me restate that. I'm evaluating an investment in becoming a CPE sponsor, provided we have enough of you that are listening that are interested in doing this. So again, if you want to post, and I'm going to probably try to put up a quick polling question. We're running late here, but I certainly welcome your feedback on that. And this is an example of where imagine this being your dashboard and having your referral partners there and being able to see, oh, geez, I was able to offer them a CPE credit because of the Financial Experts platform. So in terms of the consumer webinars, I just wanted to kind of give you a sense of, some of the topics as I see it. What I'm pursuing is the idea that, again, for those of you that would want to invite your clients, that we would have essentially a separate webinar track that's really customer or client focused. And these are some of the ideas. And again, I put this in the revised PDF that's in the handout section now, and I'll share it post-call. We'll put it on the webinar replay page. And again, I certainly welcome feedback and thoughts on this. But as I think about the consumer or client tracks, I think about it sort of with the age segmentation and varying the top by age. So the XY generation, these are some of the topics that I've identified as interest. But then when I think about boomers, if you look to the right, clearly the topics are going to change, just given the age and where clients are at that point in life. So again, I'm thinking about and researching the idea of doing more client-specific webinars, and these are some of the topics that I have in mind. Thinking about different folks, different experts that could serve as presenters on this, ones that have deep expertise, same model, but yet aren't. There's no conflict relative to you and your business. I'm very mindful of that. And then again, just a kind of a different view, I took this fella, Chris, is actually my first ever member months ago when we first started launching this. And imagine again, this would be if your clients are referral partners, and this is the idea where it would be like a CPA. Imagine that they've logged into their Financial Experts dashboard, and they would see your contact information, your picture. Again, they are there as your guest. So I certainly welcome your thoughts on that. Again, we're doing a lot of work to build out the capabilities here. Let me throw up a polling question and let me know what your interest level is. Whoops, let me see if I can get my mouse. All right, we're going to do rapid fire on the polling questions. Whoops. Oh, Mike. How about that? I clicked the wrong. Sorry. Okay, let me jump ahead. I'm having mouse problems. I'm going to launch a question. Would you be interested in inviting your referral partners? And the same if you want to comment in the question panel, if you want to let me know if you would be interested in inviting your clients to webinars that are appropriate. I get it. It's not going to be every session. And again, we would have the content designed for the client, not the professional. So again, if you could let me know, and you're certainly welcome to email me or contact me separate from this to let me know your thoughts. And then I'm going to ask you a follow-up question. So folks, if you're listening, if you can give me a quick vote, I'm going to give it 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1. Okay. And then one more question around that. So for this, it's a fairly serious investment on our part. So I'm going to ask the question, and I don't have this settled, but would you be willing to pay something for the referral partner idea? And assuming we get the CPE in place for the CPAs, would you be willing to pay a monthly fee of between $15 to $35 a month? I clearly can't do it for free. And I'm really trying to make this very accessible for everybody, but certainly would like to know what your appetite is to help pay for this program. And the idea that I'm thinking of is to have sort of two packages where you could load, for example, up to 10 referral partners, and that's X dollars. And then maybe a second version where you could load up to 25 or 50 or whatever that number is. And again, that's maybe 2X or 3X. That's what I'm thinking, is having packages. So, something that's very approachable, and then perhaps, something that's, again, you have more folks that you could have. Okay. So, all right, good. Well, thanks for your participation. Let me see. I think I got through the slides that I wanted to. Certainly, let me just check for questions and comments. See, Nathan, thank you. Interested in CPE credits for your referral partner. Great. I would tell you, having been in the education business through these webinars and offering continuing ed credits, it's 100% effective. So for you, if you've never done that, I assume most of you haven't, I've been doing it for years, and it's a very, very effective strategy. And it really comes down to the theory of reciprocity. So for your professional partners, if you were able to offer them those kind of credits and access to a great, a solid, sorry, I don't want to be too bold there, a solid educational platform, you're gonna make some new relationships and deepen existing ones. So that's been my experience. So with that in mind, the only other thing that I would share is for those of you that are members of an FPA chapter, I've had a couple conversations with FPA chapters that, given these difficult times in terms of not being able to get together and have in-person meetings, they've reached out to me to ask to explore the idea of piggybacking off my platform here for all of their members. And we're having some great discussions around that. So if you're a member of, the FPA or even NAIFA chapter or similar chapters, and your chapters are looking to figure out how do you keep the education mission going on, again, with not being able to have your partners and sponsors in on a local basis, I certainly would welcome the opportunity to chat with anybody in your local leadership about that idea. Again, I've had two different chapters that have indicated interest in that, and I think it's an interesting idea. Nathan, thank you for the suggestion about you'd be interested in a presentation. I don't have my glasses on, but is that QOF? Nathan, if you could just make sure I'm reading that properly, that would be great. Otherwise, after that, I think we're at a close here. I have to confess, I'm off to get a root canal. So I never thought I'd be in a hurry for that, but qualified opportunity funds. Okay. Is that for the qualified opportunity zones, I'm assuming, Nathan? If so, I'm going to add that to my list. We're looking to have things like donor advised funds. I need to write that down. Okay, gotcha. Okay, and I know I've talked about doing one on real estate, and that's a good suggestion. Thank you, Nathan. Okay, all right, folks. Well, thanks so much for joining. I hope you found it helpful. And again, certainly welcome feedback on Steve. I really like his demeanor and his thoughtfulness with what he does, and certainly hope you feel the same. So with that, going to wish everybody a great rest of the week, and thanks for joining, and hope you make it tomorrow for the Paycheck Protection Program with now John Fleming. So take care, and talk to you soon. Hopefully we'll see you soon.